Thatcher Taylor, ProPath Financial. Welcome back to my YouTube channel. We're going to talk about 401k, the limits, how much money can go into a 401k. We'll talk a little bit about why you would even use a 401k. I'm not here to bash 401ks or retirement plans. We're just going to talk about the limits, the little details. Each person and their situation is completely different. And so it's very impractical for me to say that 401ks are terrible at all times. But let's talk about a couple things. First, I'm going to share my screen. While I'm doing this, like, comment, share. Please be engaged in what we're doing here. This channel, I wanted to grow and continue to educate everyone. So as you can see here on my shared screen, hang on, can you see me a little bit better now? There are two annual limits that apply to contribution. There's the employee elective salary deferrals, the amount of money that you as the employee can contribute. You get paid a certain amount of money, comes right out of your paycheck and goes right into the 401k. Then there's the overall limit on contributions to a participant's account. So not only can you contribute into the 401k, but there are other sources of money that could come in to build that account value in that 401k. So everything that can go into a 401k are elective deferrals, the money that you put in. You elect to defer money into the account. Your employer matching contributions, so the employer matches. Employer non-elective contributions, them just being nice. And allocations of forfeitures, so plans can have forfeitures for a few different reasons. That money can go back into the 401k and could potentially help grow your balance. But matching contributions in 401k time, or I'm sorry, in COVID time, has really limited some companies on contributing and matching to your 401k. So be aware of that. And then non-elective contributions, every 401k plan is different. Some employers will put more in than others. But the big key that's always going to go in are your elective deferrals if you choose that. So the limits. And we're going to talk about 2021. Everything I say here is going to be about 2021. 2020 is almost over. Can't believe it. 2020, it's been a dumpster fire. But here we are. Let's think about 2021, the future. That's what we always do. 2020, $19,500. That's the most that a person under the age of 50 can put into their 401k. So that's the most that you can take out of your payroll deductions and put into your 401k that the IRS allows. That number always goes up, not from year to year, but almost year to year because there are cost of living adjustments. They allow you to put more in. Simple 401ks, if you use a simple 401k, that's a little bit different, $13,500 in 2021, so a little bit less. But simple 401ks have some different rules, but we're just going to talk about the big 401ks and profit sharing plans right now. Plans all have different terms. Most of them are the 19,500, but your plan's terms may impose a lower limit of effective deferrals. So catch-up contributions. If you're 50 and older and you're watching this channel, thank you. Glad to have you. But if you're 50 and older, you can actually put in a little bit more. In 2021, that number is $6,500. So you can put an additional $6,500 into your 401k because you're a little bit older. Catch-up contributions and safe harbor 401k plans. Simple 401ks, again, it's $3,000 in 2021. All right. So one thing we want to talk about is catch-ups for participants in plans of unrelated employers. We're just going to dive into this example. If you can see it right here. Joe Saver. What's up, Joe? He's over 50. All right. You over 50 agers watching this, you're getting some love. You only have one employer in 2020. That's common. Participates in the employer's 401k. That's common. The plan would have to permit catch-up contributions before he could defer the maximum of $26,000 for 2020. That's not what we're talking about. We're going to do the 2021 numbers, 19,500 and 6,500. So your employer has to allow catch-up contributions. Just another rule. You have to permit them. Most do, but just double check the rules. If the plan didn't permit catch-up contribution, the most Joe could defer is 19,500. Okay. If Joe participates in two 401k plans, so for some reason Joe's saver, he's a go-getter, works for another company, has two jobs, is trying to make ends meet or save as much money as possible, become a millionaire. Good for you, Joe. And you're going to save more money in another 401k plan. You can defer a total of $26,000. So when I say defer, you can electively choose to defer more money to a 401k. So then you can start to put more money in up to that $26,000 if neither plan has a catch-up provision. Of course, Joe couldn't defer more than $19,500 under each plan, and he would be responsible for monitoring his own contribution. Just remember, $19,500 is the most that you can contribute in any given year. So you would need to monitor that. So for example, you have two 401k plans, you put more than $19,500 or $26,000 in there because of the catch-up contribution, and you put more in, you have the ability to remove the excess deferrals. Say you put $28,000, $29,000 or $30,000 in from paycheck deferrals because you had two jobs, you made a mistake, you need to fix that. You can do that. You have until April 15th of the next year, your tax filing deadline, to do that. Excess deferrals that are withdrawn by April 15th are includable in your gross income from the prior year. So remember, when you contribute to these 401ks, the pre-tax portion, I'm not talking about Roth, when you contribute to the pre-tax portion of your 401ks, you get a tax deduction. So let's say you make $150,000 in a year. That's your gross income. That's your salary, 150 grand. And you put in $25,000, just round number. Your new taxable income is $125,000. That means that $25,000 was reduced off your gross income. So you're not going to pay taxes on that money in that year that you contribute to the 401k. But down the road, when that money comes out of the 401k, or if you roll it into an IRA and then it comes out of the IRA, that money's taxable. So that's why here the money is that if you contribute too much outside of the limit that we've already discussed for your elective deferrals, the money that has to come back out goes back on your gross income, so you do not get that tax deduction. So there is the second limit. So let's go back to the top here. We've talked about two annual limits, or I mentioned that there are two annual limits, and we've only talked about one, the employee elective salary deferrals. But there's an overall limit. That's the second limit we haven't dove into. The overall limit on contributions is a bigger number. So again, there's the elected deferrals. We should be familiar with that. There's the employer matching contributions. So you contribute X amount and the employer says, I'm going to contribute a certain portion of your contribution as well. So I'm going to match it. Then there's the employer non-elective contribution. I once had a job where I would contribute X amount, they would match. But in addition, there was a third component where just out of the kindness of their heart, they would contribute an additional 10% of my salary into my 401k. Basically, it was 15% of my salary was going into my 401k. That was pretty cool. And then allocation forfeitures, if there are forfeitures in a year for whatever reason, there are a few options of forfeitures, that money can go back into your account as well. So the limits are 100% of the participant's compensation or $58,000, whichever the lesser of those two is. 100% of the participant's compensation or $58,000, the lesser of the two. So say, for example, you make 100 grand, the maximum you can put in is $58,000. If you only make $58,000, you can put 100% in, the lesser of the two. Right here, an employer's deduction. So you get the deduction. We spoke about that. You make 150 grand, you contribute $25,000, you get the deduction of $25,000. Your new gross income, or the amount that you're going to be taxable on, the AGI, whatever, is going to be $125,000. An employer gets a deduction as well, though. Why do you think employers want to put money into these accounts? An employer's deduction for contributions to a defined contribution plan cannot be more than 25% of the compensation paid or accrued during the year to eligible employees participating in the plan. They get a tax deduction as well, the employer. So you need to be aware that they're also receiving a tax deduction for the money that goes in. There are a couple of examples here that you can read through. I'm going to link this in the comments below so you can read through what I'm looking at here. There are also some amazing hyperlinks in here. But you need to understand, here's what we need to remember, that the annual contributions to all of your accounts maintained by one employer and any related employer This includes elective deferrals, employee contributions, employer matching, discretionary contributions, and allocation forfeitures to your account, but not including catch-up contributions, may not exceed the lesser of 100% of your compensation of $58,000 for 2021. You have to be aware of these limits on how much money you're putting in, especially for you high income earners. You have to really monitor these limits. So let's circle back. I mentioned some in the beginning, the value of the 401k. So the big value in the 401k is the match. The match. I told you my company gave me 15% at one point in time, which was awesome. Thank you for that. That was real money that went in there. If you hear any knucklehead in social media or someone trying to sell some crap and they say the money in 401ks is funny money, it is so stupid. Just unfollow them. They're a drain on your mental space. But the match is very valuable. That's money that's going to go in and help your account grow over long periods of time. Any non-discretionary contributions that go in are helpful as well. But you need to know that although you're going to get a tax deduction now, in the future, when all that money comes out, say you put $500,000 over your years into your 401k and it grows to $1 million and you retire and that $1 million goes into an IRA or stays in the 401k, anytime you pull money out of that $1 million, it goes on your tax return as income. So although you're getting a tax deduction up front and then you're getting deferral on the growth as well, all that money becomes taxable in the future. So you need to start asking yourself the question, do you want to pay taxes now or do you want to pay taxes in the future? The other option is the Roth component, being able to just bite the bullet, pay the taxes now. And then in the future, all the money in the Roth is potentially tax free. So there are options that need to be evaluated when we're planning around 401ks. Again, I'm going to link this below. Please reach out to me with any questions or concerns, comment below. Let me know if I said something wrong. I can correct it in the comments or in the notes section. I'm happy to do that. Please like, subscribe, follow, help this page grow. The more likes and subscribes to this page, the more content I get to throw out there. Thanks for stopping by. Thanks for listening. This is uncut, unedited. Have a good day.